Hi everyone, welcome to the online class Kilora. Last class we have discussed about the ledger account, journal entries, all other things like cycling, accounting cycles also. So today we are going to continue this accounting cycle with the topic trial balance. So let's understand the meaning of it. A trial balance is a list of all the journal ledger accounts, both revenue and expense capital. It contains a company accounting system also, and it includes a respective debit and credit balance. It is typically prepared at the end of the accounting period to ensure the accounting equation, that is asset is equals to liability plus equity, it should be balanced. And let's know what are the things which involves in this trial balance. The first one is debit and credit. So here each transaction in accounting is recorded with the double entry system, where it says that debit must be always equal and opposite to the credit. So it is based on an accounting equation. And the second one is ledger account. Here, the general ledger contains all the accounts used by the company. So, by converting the journal to the ledger, we'll have such kind of accounts like cash account, account receivable, account payable, expenses, and revenue account, etc. The next one is trial balance. Here, it is the overall summary of all those accounts and the balance at a specific point in time. So, at the end of the financial period, we are going to prepare this trial balance. And the next one is debit and credit balance. Here, the accounts with the normal debit balance includes assets and expenses, and the account with the normal credit balance includes liability and revenues. So, this is the basic thing you have to understand. And the next one is balancing. Here, the total debit must always will be equal to the total of all the credit balance. It should be ensured that the accounting equation is maintained. With the accounting equation, asset is equals to liability plus equity. And the next one is wrong on errors. Here, while preparing this trial balance, if it is not balancing, then it indicates an error or a mistake in the accounting records. So you have to go and verify and post it again. And the next one is the trial balance is a crucial tool in the accounting process. So it offers several advantages for business and accountants. Here, these are the advantages of trial balance. Here, the first one is error detection. Here, it is one of the important advantage. So it detects the error in the recording and posting of transaction. So if the trial balance does not balance, it indicates that there is an error or a mistake in accounting records, that is in journal entry or ledger entry. So we need to identify and correct it. So only when it is correct, only the trial balance will be balanced. The second one is verification of accuracy. Here, a balanced trial balance provides a strong indication that the total debit should always be equal to the total credits. So it ensures that the accuracy of a mathematical aspect of recording accounts. So this helps us in building the confidence in the financial information. The next one is facilitating of auditing. Here, the external auditors will engage in reviewing a company financial statement. So it starts by examining the trial balance, and which is well prepared and balanced trial balance can expedite the auditing process and instill confidence in the accuracy of the financial records. The next one is organization of accounts. The trial balance organize accounts by categories like asset, liability, equity, expenses, and revenues, which makes easy for the accountant to review it and easily and quickly understand the overall financial structure of the business. So you can know what is the position of the company, what are the performance and overall of the company. The next one is legal and compliant requirements. Here in judiciarism, um, companies are required by the law to maintain the accurate accounting record. So it balances the role in meeting the legal and compliant requirements by ensuring the accuracy and completeness of the financial data. Let's know the methods of preparing the trial balance. Here, the first method is very important, and as you know that it is a double entry system. Here, the trial balance is based on the double entry system and also an accounting equation which where all the transactions has equal and opposite effect on the at least two records. The second one is journal ledger. Ensure that all the transactions are recorded in the ledger account. Each account should have a debit or credit entry. So it depends on the nature of the transaction. And it has each account will be debited or credited. The next one is account balance. Here, by determining the balance of each journal or ledger account by totaling the debit and credit, it includes opening balance and also, if applicable, and closing balance also. The next one is listing of accounts. Here, by listing all the accounts from the journal ledger, includes assets, liability, equity, revenue, and expenses also. Like in a simple way, in a simple term, like cash account, sales account, purchase account, bank account, etc. Debit and credit column. Here, as I told that the one side will be a debit balance and other side will be the credit balance. Enter the amount names in the respective column and balance it. The total debit and credit. Added with the total debit and credit separately ensures that the total debit equal to the total credit. This is a crucial step to verify the accuracy of reporting process. And next one is as error checking. As I told, this trial balance helps us to indicate the error or a mistakes in the recording transactions of journal entry or ledger entry. So it is ensured that each transaction is correct and recorded and the debit and credit are going to match and balance. The next one is closing entry. After preparing this trial balance, you're going to end up with the accounting period to close the revenue and expenses account to the retained earnings or equity account. And the last one is financial statement preparation. After the once the trial balance is confirmed to be balanced, use the information to prepare the financial statements like income statement, balance sheet, and statement of cash flow. Let's have an example. From the following ledger balance a trial balance of Mr. Santosh for the year ending 31st 2023. So here these are the ledger balance. When you're going to convert the journal entry into ledger, you'll get the total amount, that is each account will have this kind of amounts. Like the salary will be 5,000, credit will be 6,000, debit will be 6,000, and building will be 3,600, capital is 4,000, and motor car is 4,000. Purchase is 5,000, sales are 4,800, and rent is 8,800. So you're going to balance it. Like you'll go and post it in the debit column. The balance amounts which are going to the debit column and which you are going to post it in the credit column. This is how you balance it. When you had all the total debit column and all, when you had all the total credit column, you have to get the same amount which should be equally balanced. So when you're going to take salaries, salary will always come in the debit column, and this credit will come in the credit column, this debitors will become in the debit column, and building in the debit column, capital will come in the debit column, and also the motor car debit column, and purchase debit column, sales credit column, and rent will be in the credit column. So when you total it, you'll get an amount, that is um, when you had all this, you'll get an amount which should be balanced, of total debit is equal to total credit. The next topic is adjusting entries. Here, adjusting entries are journal entries made at the end of the accounting period to update certain accounts and ensure that the financial statement reflect the true economical situation of the business. So these entries are necessary for the complying with the accrual basis, that is cash basis of accounting, and to match this revenue and expenses in the period they are incurred. There's common types of adjusting entries. So The first one is accrual. Your accrual revenue, accrual expenses are there. Here in the accrual revenue, when you're going to record the revenue that have been earned but not yet received or invoiced. So when this kind of transaction comes, you need to debit the debit asset account in the debit column and revenue account in the credit column. And when it is accrual expenses, the record expenses that have been incurred by not yet paid, and that time the expenses account will be debited and the liability account will be credited. And in the second type of adjusting entry, that is prepayments, that is also called deferrals. And when it comes to the expenses, prepaid expenses, here that just for the expenses that has been paid in the advance but have not been incurred yet, for that expenses account will be debited and the asset account will be credited. For example, prepaid rent. When it comes to the depreciation, adjustment for the decrease in the value of long-term asset overall time, like equipments, buildings, plant and machinery. The debits and expenses accounts like depreciation expenses and credits the accumulated depreciation account. When it comes to the bad debts, here by estimating the portion of the account reserved that may not be collectible. So here the expenses account will be debited and the allowance for the doubtful accounts will be credited. This is very important thing. So in every adjustment, this bad debts will be applied. So you have to understand this concept. In every question there will be one of any one of the adjustment, that is balance sheet. And the next one is interest. When the interest earned or interest incurred adjustment is given but not yet recorded, for that kind of account, here the debit or credit and interest revenue or expenses account will be recorded accordingly. And income tax, here adjust for the income tax based on the cash basis. Here the income tax expenses account will be debited and the income tax liability account will be credited. The next one is salaries and wages. Here, when the salaries and wages that has been earned by the employees but not yet paid, for this type of adjustments, the expenses account will be debited always and the credit the liability accounts. When it comes to the insurance, the portion of prepaid insurance that have been expired during the period, the expenses account will be debited and the prepaid insurance account will be credited. The next topic is closing entry, and this is the last topic. And let's go with the meaning of it. The closing entries are journal entries made at the end of the accounting period to close out the balance of temporary accounts and they transfer all the balance to the permanent account. Here, the temporary accounts are revenue, expenses, debit account, etc. Permanent accounts are assets, liability, and equity. This is very important. You have to know this. The main purpose of this journal closing entry is to prepare the accounts for the next accounting period and also to ensure that the income and expenditure expenses account should start with zero balance. The first one is close revenue account. You debit each revenue account to close it. This step transfers the credit balance in the revenue account to the income summary account. For example, if you have a revenue account such as the sales and service revenue, you'll debit these account so the credit account in the credit side of the account will be closed. Debit each revenue account to close it. And when it comes to the close expenses account, here the expenses account to the income summary account will be debited. For example, if you have an expenses account such as rent expenses and salary expenses, you'll credit this account. So it will be balanced in the debit balance in the expenses account to the income summary account. The next one is close income summary. Here, by transferring the net income or net loss for the income summary account to retain earnings. So, if there is an amount which is income summary account credited, then it will always be a net income. When it is income summary account debited, it will always be loss. So you have to understand, if it is debited, it will be always net income. If it is credited, it will always be a net income. Sorry, if it is debited, it will be net loss. If it is credited, it will be net income. The next one is close dividends. Here, if the company distribute the dividends, debit the retained earnings or equity account to close it. So it will reflect the deduction in the equity due to the distribution of profit to the shareholders. So this is how the dividend works. Stuff will be closed. If it is going to deduct or close it, you'll go and distribute the profit to the shareholders. Verifying balance. Here, ensure that the temporary account, that is revenue, expenses, and dividend, will be a temporary account, will always have a zero balance after entering closing entries. When it comes to the permanent account, asset, liability, and equity account will always retain their balance. So here, the when it is a permanent account, it will retain the balance. The last one is closing entries are important for the following reasons. So you have to know that why these closing entries are important. Because of these two reasons. That first one is zeroing temporary accounts and income summary account. Here, when it comes to the zero temporary account, the temporary accounts are close to the zero at the end of each accounting period. So it allows them to start freshly in the second period. So you won't understand this. When it comes to the income summary account, this income summary account serves as a temporary holding account to summarize the net income or a net loss for the period before transferring it to the retained earnings or equity. So, thank you.